Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the big losers in today's session so far is Nike, down 9.5% right now. Quite a bit going on there. So let's bring in Poonam Goyal, the senior U.S. e-commerce and retail analyst at Bloomberg Intelligence. Poonam, Nike is in turnaround mode. Elliott Hill is no longer a new CEO. He's just the CEO because he's been there for about a year. How is his effort to turn this company around shaping up?
I think his efforts to turn U.S. business is shaping up quite nicely. We are seeing momentum rebuild in the U.S. The issue is outside of the United States, in China specifically, where sales have really plunged. And we don't think that they can, quickly rebound those sales anytime soon. It may be a 2027 story to see any resurgence in China, if that.
What is the issue in China? Is it their brand specific? Is it the Chinese consumer? What's going on there?
I think the biggest issue is brand specific. So unlike in the US, the Nike brand isn't perceived as a higher end athletic brand. In fact, it's sold way too much and off price and at discount. So the brand needs to build brand momentum and brand heat. And yes, the Chinese consumer isn't particularly, on its best feet right now. But if you compare what's happening in China and you look at Lululemon has had outstanding results in China, much smaller, but they've been able to do really well there. So Nike really just needs to get its stuff together when it comes to product, branding, and marketing in that region.
What is the playbook for that? Have they outlined something that sounds reasonable, or is it kind of still throwing things at the wall?
I think the playbook will be similar to what they did in the US. The first thing that they've done so far, and we'll see how that works out, is changed the reporting structure. So now all regions report directly into Elliott Hill. So I guess he just has more authority over those regions, seeing things, firsthand. The other thing that they're going to try to do is just clean house there, right? They have to get rid of the inventory that's just not speaking to the customers and has been aged for some time. They have to get out of off price and they have to stop discounting. And then once you get new product to flow in, you get the right brand message across. It's retail playbook 101. They just need to execute. So execution is huge here.
Talk to us about the Converse brand within the Nike household there.
So the Converse brand, yes, it's struggling, but to me, it's less of a concern than China. The brand is less than 10% of their total revenues from what we see. And while sales are down, and while it is a brand that we'd like Nike to see step up, especially when it comes to lifestyle, other companies have done particularly well there. We'd say the focus, if I needed them to put focus on one thing first, it would be China right now, Converse after that. And that's what we're looking for.
And I know that there's been a lot of discussion between performance and lifestyle over at Nike. What is the path forward for Nike? I mean, has it chosen performance across all of its markets, or are some markets better for performance versus lifestyle?
So they're sticking to performance, and I think that's the right choice because performance is what Nike is about. It is what drives the sport's momentum. What we'd like to see happen is that performance turns into lifestyle. So a lot of shoes that are worn for the sport or for the game have become lifestyle shoes too. So that's the natural shift that we'd like to see with the new innovation that Nike is launching.
So we have some experience now, 9 months, 10 months, 11 months of just tariff discussion. Poonam, I think you were one of the first analysts we talked to say, oh boy, what's this going to mean for various industries? What's it mean for your business, the athleisure business, kind of the Nikes of the world, the Adidases of the world?
Yeah, so footwear is largely imported into the U.S. and so is apparel. When you think the athletic wear space, notably the footwear, it's predominantly made in Vietnam, and the current tariff there is 20%. It will have an impact on margins. In fact, Nike's gross margin, if you look at it, even what was recently reported, more than half of it was due to tariffs, and same with their guidance. So I think 20% exposure, they are increasing prices selectively. They probably will have more efforts in place in 2026, that's calendar 2026, to mitigate some of this, but it's not going entirely away. It is a headwind to margin.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, a bellwether for some, including myself, for the U.S. economy is FedEx. FDX is the ticker. They reported some numbers. Stock trading a little bit lower here. They had some issues with some of their aircraft, but I don't know. I kind of think it's just an awesome company. The stock is up it's about flat this year. It hasn't really done anything here, but it's got a market cap of $67 billion. I've always been a big fan of FedEx. The MD-11 is a great aircraft, but it's an old aircraft, and they have some reliance on that. Lee Klaskow does this stuff for a living. Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence. Lee, I knew FedEx reported some numbers. What did you learn?
Well, I mean, their second quarter, they performed pretty well. And, they gave us some color about the peak season from an average daily volume growth. They're looking at mid-single digits. That could increase to high single digits because there's one extra operating day in the quarter, or during peak season, I should say. So, they seem to be executing on their restructuring plan. The problem is that in their second half, they're going to be having a lot of headwinds that they're going to have to deal with. And those headwinds relate to, higher variable compensation expenses, and a less than truckload market, which they're the biggest player in that market, that has been pretty depressed over the last couple quarters, and it's going to probably continue to be depressed. And then you have, as you mentioned, the grounding of their MD-11 fleet following the tragic accident of a UPS plane a couple of weeks ago. So, you add those three things up, plus some other things, it's about a $600 million headwind to its earnings. So they have to deal with that. And some of the restructuring that they've done, probably, you're probably not going to see hit the bottom line, at least really directly, until their 2027.
So the $600 million charge clearly not impressing investors, even with the beat in the quarter that ended. Is this a one-time thing, or is this something that could drag out beyond the second half of next year, excuse me?
Yeah, so on the MD-11s, I think expectations are, they should be back in service sometime early next year. I don't really know exactly when that's going to happen, but so you could view that as a kind of a near-term headwind. The variable compensation, that also is against difficult comparisons, so that's also short-term in nature and not something that is going to continue. The biggest unknown for me, at least, is the less than truckload demand. The ISM manufacturing index, which has been contraction territory for 35 out of the last 37 months, is indicating that less than truckload demand, which is mostly industrial manufacturing, is going to continue to be weak in the coming months ahead, because that index, the ISM index, is really a bellwether to an early indicator of where LTL demand is heading.
Lee, as you know, I am an expert on trucking. I know what LTL means and TL means. I had no idea that FedEx was the largest LTL provider. Do you like them that they're in that business, or would you rather them farm it out to somebody?
Well, that's a great question, Paul, because they're planning on spinning that out in June of next year.
Boom, banker.
Yeah, there you go. The argument always was that, maybe they could cross-sell their LTL and get more profitable parcel business. That model really might have not played out as much as they hoped. And so they also hope to get a better valuation, because that LTL business, while it's been pretty depressed, it does trade at a higher multiples. And so they're trying to unlock kind of some of the value there. So, it'll be pretty interesting to see how that company operates as a standalone provider. That industry is pretty consolidated and has a lot of pricing discipline. And we just hope that, once FedEx Freight gets out there and they're on their own, they're not going to try to use pricing to gain share. But we would note they are still the largest player. So it's not like they're looking to to gain a lot of share anyway. So, but it will be an interesting thing to see once that gets spun out in June.
I'm looking, Lee. I'm looking at Paul and talking to Lee. In the past 6 months, FedEx shares up about 29% total return versus UPS up almost 6%. Can you compare and contrast their approach to some of the macro challenges that faces the industry?
Yeah, so they're both in the process of restructuring their networks to deal with the new realities that, B2C or e-commerce is really where the growth is going to come from. And these networks were created a long, long time ago with the idea that, a carrier would go to a lawyer's office with 100 envelopes, drop off those envelopes, and pick up 50 envelopes. And that density really can drive profitability where, as if you get if you order rubber bands from Amazon, that one package that goes to your doorstep is a lot more expensive to deliver. So they're just dealing with that reality, and they've been slow to kind of change their networks. And UPS and FedEx are both in that process. UPS has done things a little earlier, I would say, and whether it is they spun out, or I should say sold their less than truckload business, the TFI, a Canadian provider, a couple of years ago.
Right.
They're all looking to try to gain more share of the small and medium-sized shippers and get away from the large shippers like Amazon, which really aren't that profitable.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Scarlet, I have breaking news. You may want to get the red headline ready for this one.
Okay, tell me.
Today, I put a deposit down on my first cruise ever.
What? What prompted this?
Well, my partner, my girlfriend, we're doing it in the fall.
She just told you.
Viking cruise. Yeah, basically. Viking cruises, Europe, France in the fall.
And how are you feeling about this?
I'm a little nervous, but it's baby steps, she says. It's not like a big carnival cruise where you got like 5,000 people on. It's a little riverboat, kind of cruise.
Okay, so in 2 years, we should look for you on a carnival cruise.
Could be. But that brings us to our next guest. Brian Egger, he's writing the research note right now as we speak. Sweeney in the cruise business. Brian Egger, he's a senior gaming and lodging analyst for Bloomberg Intelligence. Brian, we had Carnival Cruise Lines reported some numbers today. What did they have to say?
Yes, the fourth quarter, the fiscal fourth quarter ended November 30th, was a pretty decent quarter in terms of yield growth. And I think more importantly, going to next year, they are expecting to see about 2.5% revenue yield growth or so with good cost control. And that's encouraging because there were some concerns that industry growth of supply, particularly in the Caribbean, not by Carnival, but by its competitors, might dampen yield growth going into next year. So while there's still some uncertainty, I think overall the takeaway was fairly encouraging on that front.
How much of their business depends on converting people like Paul Sweeney from a never cruiser to a maybe cruiser to a reliable cruiser? Basically increasing their market share by bringing in new customers.
Yeah, historically, it's been a big factor in North America trying to attract that first-time cruise customer. It's far less penetrated than other forms of vacationing. That's even more true if you go into other parts of the world like Europe and Asia. But it's definitely part of that first-time customer. On the other hand, much what they do depends on loyalty programs and getting repeat business as well.
So, Brian, give us the consumer's kind of wavering a little bit there. The K-shaped economy. How does the cruise industry deal with that? Because I know there's different tiers of cruising out there. How do you see that in the cruise business?
If you go back historically, the cruise industry is moderately cyclical. Probably yields have been more resilient than, for example, business travel-oriented hotel room rates. So there was obviously some vulnerability. But that being said, the leisure consumer of travel has been really resilient. It held up extremely well throughout this period of economic uncertainty. Historically, passenger growth has kept up with supply. The good news for Carnival is they've only looking at about 1% supply growth in 2026. There's certainly more coming from their competitors, but that supply outlook for them specifically is a healthy backdrop, even if we do see a setback in consumer spending.
Speaking of their competitors, I'm just looking at a comparison chart of all the big cruise operators, and Paul's Viking is up about 64% so far this year. Carnival up about 23%, Norwegian Cruise Line down 11%, and Royal Caribbean up 30%. How are their strategies different? I mean, for those who don't cruise, it might seem like they're all one and the same.
Yeah, I think there are different ways you could interpret those disparities in stock price performance. But I think the way I think about it is Viking certainly very focused on the luxury kind of niche cruise segment.
Paul is fancy.
Yeah, good for Paul. And I think generally speaking, that part of the business has held up well. Carnival probably is maybe gained some note because it's done a good job at achieving its return on invested capital goals, done so sooner to get to that 12% range than they expected. And because they've got so little supply growth, that does provide a little bit more conservatism. But, there are certainly some differences across the brands.
All right, Brian, how are my friends on the Strip in Vegas doing these days?
Yeah, I mean, Vegas is finishing up the year with modest growth. But it was a tough summer period in Las Vegas, particularly kind of the mid-market segment. Much like I said about cruising, the high-end hotel business, luxury-oriented demand is held up better. But the mid-market, midweek demand during kind of shoulder periods and the mid-market has experienced some disruption, probably because of construction, probably because of difficult comparisons, probably because we are seeing that luxury end of the market holding up a bit better.
So is everyone then going to double down on chasing after the luxury customer?
Yeah, it depends on what part of the business companies are in. On balance, Wynn, which is more high-end, has performed better in terms of its RevPAR, let's say in Las Vegas, than some of its rivals. But those are these trends shift. But I think that's been notable across the leisure travel sector is the relative outperformance of luxury high-end, with perhaps a little bit more challenging comparisons and difficult conditions for kind of the mass market or those dependent on other sources of business.
And we know that these gaming companies, these casino companies, rely a lot more on China than they do on the Strip overall. How's Macau looking for them?
So, I mean, Macau has been recovering, particularly what we call kind of the mass business in Macau, that has some ancillary effect on Las Vegas as well. Although, low luck levels and baccarat in Vegas have been a bit soft in some periods this year. But, that business is certainly coming back in Macau. It's coming back a lot after, obviously, the pandemic. It's just a different type of business.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
A news story that's got a lot of people's attention, like my kids are paying attention. TikTok is being bought by a group of buyers led by Oracle Corporation, with the company and ByteDance signing binding agreements to create a U.S. joint venture. I don't care, but a lot of people do. Mandeep Singh, Senior Tech Analyst for Bloomberg Intelligence, joins us. Mandeep, talk to us about this structure here. I know that the government was either to ByteDance, which is a Chinese company, either sell this thing or shut it down. Does this satisfy kind of the requirement here?
I think so. And look, the main point of contention was the algorithm. So clearly, there is a decoupling of that versus the app. And, in terms of the ownership, Oracle was the most likely sort of candidate when it comes to leading this joint venture. And that turned out to be the case. So from that perspective, I do think this should be palatable to both the U.S. and the Chinese government.
Although we don't know if the Chinese regulators will definitely approve it, right? They have yet to say whether they'll approve this transaction.
I mean, we have seen that many times. A lot can go wrong, but in this case, at least, the joint venture that was formed here had the blessing of the U.S. government. So it sounds like, this was the intended proposal, and that's how it turned out to be in terms of ByteDance, agreeing to sell the app to this joint venture.
What I like about this is it includes Silver Lake. And for my money, but based upon my career, the smartest technology PE money out there by far is Silver Lake. Some really smart folks there. So if they're involved, it's got to be a good deal. That's how I look at it. Mandeep, talk to us about what the competitors are thinking here. Is TikTok still as formidable going forward, do you think, as it has been?
Not really. I mean, if you look at the run rate of Instagram Reels, they have surpassed $50 billion in run rate. That would have been unimaginable given the kind of lead TikTok had over Instagram, and Instagram Reels came from behind, and now they have a $50 billion run rate. Same thing with YouTube Shorts. They have an engagement share that's almost surpassed TikTok at this point of time. So clearly, the last couple of years, TikTok seems to have lost steam when it comes to the pace at which they were adding users and the engagement growth, etc. And if I had to ballpark, the U.S. revenue of TikTok would not be, over $12 to $15 billion. So Reels being at $50 billion just goes to show what kind of a missed opportunity that was for TikTok.
Interesting. So what does this mean for Meta, which owns Instagram and Reels, and of course and is now firmly in the lead and is no longer playing catch up to TikTok?
I mean, a lot of this, revenue ramp up for Reels was driven by the fact that, Facebook or Meta had a better ad stack, and they kept, improving that with more personalization. Now with applying generative AI on top of that, that has helped them with ad pricing. So these are incremental things where TikTok, couldn't even keep its algorithm. So the fact that, they have to redo the algorithm, redo the ad part, the personalization part is likely the reason why their ad revenue hasn't ramped up. And it's going to take them a while, even if, this joint venture would start putting money into the company to, improve its algorithm and personalization. I don't think it's going to happen that quickly in terms of where they were, 2-3 years back.
Should we expect this new joint venture to maybe go public at some point?
Still early days, I would say, given the algorithm change is a big one. I mean, you have to, even though, users are used to coming to the app, you have the traffic, but we know in the world of AI, it's about personalization. It's about that recommendation system and, rewriting the algorithm. I do think it's going to take a while, and it comes down to, what kind of talent they can attract into this new entity. So a lot has to go right before, we can look at this joint venture going public anytime soon.
That would be really interesting.
I'm still going to go make the pitch. If I were a banker, I'd be right on the doorstep today. No doubt. I want to be the first guy there and saying, let's take this thing public. Here's what you need to do. And
you think they're ready? This is something that they want to do?
I don't know. I would think so. I mean, I could bring a lot of money to
Is the administration going to play a role in that?
Oracle would focus a lot more on their cloud business right now and the ramp up there. I don't think they have the time to focus on reviving TikTok.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.